All right, let's talk about retirement. Whether it's a 401k, a company pension, whatever you call it, most of us are counting on some kind of plan for our future. But how do we actually know that money is going to be there when we need it? Well, today, we're pulling back the curtain on the rule book that makes sure it is, a standard called IAS 26.
And this really is the multi-trillion-dollar question, isn't it? There are literally trillions of dollars set aside in these funds all over the world. So how do we get a clear, honest picture of their financial health? How do we know they're being managed the right way? That's exactly what this standard is for. So let's dive in.
So here's our game plan. We're going to start with the basics, what IAS 26 even is. Then we'll get into the two main kinds of retirement plans you'll see out there. After that, we'll look at how each one has to report its numbers, cover some rules that apply to everybody, and then wrap it all up with why this stuff is so important.
Okay, so what exactly is this standard? Think about it this way. A big company, say Ford, has its own financial statements. Well, IAS 26 says that Ford's retirement plan needs its own totally separate set of financial statements. It's the rule book for the plan itself, not for the company that sponsors it.
The first big idea to get your head around is the retirement benefit plan. The standard treats the plan, the pension scheme, the superannuation fund, whatever it's called, as its own little company, its own reporting entity. This is so critical. We are not looking at the employer's books. We're looking at the books of the retirement fund itself.
And this slide draws a really clear line in the sand. IAS 26 is for the financial statements of the whole plan, whether it's some official written down plan or just something the company has always done. Now, what's not covered is super important. It does not cover what it costs the employer to provide those benefits. That's a whole other standard, IAS 19. And it's not about your personal annual statement or things like Social Security. This is all about the health of the entire fund.
Right, so all these retirement plans that the standard covers, they basically fall into one of two big buckets. And understanding the split is the key to, well, pretty much everything else.
First up, you've got defined contribution plans, or DC plans. The savings pot analogy is perfect. Your employer, and maybe you too, put a defined amount of money into the pot. What you get at the end, it completely depends on how much went in and how well those investments did. Here's the kicker. The employee, you're the one bearing all the investment risk.
And on the other side of the fence, we have defined benefit or DB plans. This is a totally different world. Here, the focus isn't on what's going in, it's on the outcome. The plan makes a promise to you, a promise of a specific payout, usually cooked up from a formula using your salary and how long you work there. In this model, the risk is on the plan or the employer to make sure there's enough cash to keep that promise.
So putting them side by side like this just makes it crystal clear. With a DC plan, your benefit can change, and you're taking the risk. But with a DB plan, it's all about that set promise, and the risk flips over to the plan. And that fundamental difference in who holds the risk, that's why actuaries, the financial wizards who calculate these long-term promises, are absolutely essential for DB plans, but you don't really need them for the simpler DC plans.
Okay, since the DC plans are more straightforward, let's start there. When it comes to reporting, it's really all about following the money and being open about what's in the fund.
For a DC plan, the reporting is pretty direct. It all boils down to transparency. The plan has to show you its net assets, lay out its funding and investment strategies, and tell you how it's been performing. The goal is to give every single person in that plan a clear answer to the question, what's in my savings pot and how is it being looked after? Simple as that.
Now, let's wade into the deeper end of the pool, the world of DB plans. Reporting here isn't just about counting the cash on hand. It's about figuring out the value of a promise that might not be paid for decades.
Okay, I know this sounds like a huge mouthful, but it's the most important idea for DB plans. Let's just break it down. An actuary calculates the giant lump sum of money the plan would need today, right now, that if invested would be enough to pay out every single benefit it is already promised for all the work employees have already done. You're basically putting a price tag on a future promise in today's dollars.
So how does a plan actually report this giant promise number? Well, as you can see, IAS 26 is actually pretty flexible. It gives them three choices. The most direct way is option 1. Just show the surplus or deficit, are we ahead or behind, right on the main financial statement. The other two options are a bit less direct. You can either tuck the number away in a note or just point to a separate, super detailed report from the actuary. And all three are perfectly acceptable.
But this is where it gets really interesting. How does an actuary even come up with that number in the first place?
Well, there's a real debate. As you can see, one side says you should use current salaries. It's more objective, fewer guesses. The other side says, no way. You have to use projected future salaries, because that's what's actually going to happen if the company keeps running. What's wild is that IAS 26 doesn't pick a winner. It lets plans use either method, as long as they tell everyone which one they chose.
All right, so we've covered the big differences between the two types of plans. Now let's get into some really important rules that apply to both of them, no matter what.
This right here is the golden rule. It is so simple, but it is so powerful. All of the plan's investments have to be reported at their fair value. And why is that? Well, because using the price they paid for an asset years ago would be totally misleading. Fair value, what the assets are worth on the market today, gives you the most honest, up-to-date picture of the money that's actually there to pay benefits.
And beyond just using fair value, all plans have to provide these key disclosures. They've got to show how their assets changed over the year, what accounting rules they're following, and any details about the plan itself. And that last one there, details of any investment in the employer, that one is a big deal. It's all about making sure everything is out in the open and preventing any potential conflicts of interest.
And that transparency has to be really specific. To stop a plan from hiding big risks, the standard says you have to disclose any single investment that makes up more than 5% of the whole pot. This is a huge rule. If a plan has put a massive bet on one single stock or one property, the people in that plan have a right to know about that concentrated risk. You don't want all your eggs in one basket.
You know, we've gone through a lot of technical stuff here. So let's just zoom out for a second and ask the big question. Why does any of this matter? And it really all comes down to two simple words: transparency and trust.
This quote, which is adapted right out of the standard, just says it all. The entire reason IAS 26 exists is to let people, participants, regulators, anyone, answer one basic question. Is the pile of money, the accumulation of resources, on track to cover the mountain of promises the plan benefits? It is a financial health check for the retirement security of millions upon millions of people.
And that leaves us with one last thought. We've talked about rules and valuations and disclosures, but is this all just a technical accounting exercise? Or is this kind of clear, consistent, and transparent reporting the very foundation that allows us to trust the systems that are supposed to take care of us when we retire? Something to think about.